Hey, the IRS is notorious for taxing everything. I mean, the code says from whatever source derived. Gross income is from whatever source derived. And then what we have to do is we have to look for exceptions within the code. Well, you know what? One of the biggest exceptions is an exclusion under Section 280AG. And what that does is it says that we can rent our personal residence for up to 14 days and we get to exclude the income. Not just we get to deduct it, we completely exclude the income, which is fantastic. Now, a lot of times people find this when they're renting like an Airbnb or whatever, they kind of stumble into the section and they're excited to learn that, hey, I don't have to include this income, right? Because you can do it, if you live in, say, Tallahassee, Florida, maybe you're renting the games out during or your house out during some of the Knowles games, right? Or maybe for graduations, or if you have concerts in your area, or if you're in, say, near Orlando, maybe you're renting it out for families that come down for the amusement parks and you're doing it for the 14 days. Well, that money is going to be excluded. But you know what? We can take it a step further. If you're a small business owner, this is huge for you, because what you can do is you can rent your house to your business for legitimate reasons. And then what happens is the money that your business pays you is not taxable. It's excluded, right? So you get the money, it's excluded, and you get a double benefit because the proceeds that the business paid you, your business paid you, are deductible from their taxes as well. It's a huge benefit. So the purpose of this video is to go through, walk you through the process. What are the requirements? And I'm going to break it down by the individual and by the business. Now, before we do that, what I want to do is I want to show you the code sections, because sometimes you hear of all these great tax tricks out there and then there's no code section associated with it and you're like, wait, what's going on with it? Well, this isn't a trick. This isn't a gimmick. It comes directly from the code. I'll show you the code section. We'll look at the language a little bit. Then we'll go in, we'll see how it applies, and I'm going to give you some common mistakes. So that's the agenda for this video. So let's go ahead and get started. Let's look at that code section. All right, let's look at the basic code section. Okay, so again, we're dealing with the Internal Revenue Code. We're dealing with Section 280. You have the site up there. And here's what it's saying. And I took out a little bit of the language to make it a little bit easier. And what I did is I put the red boxes around the keywords so you can see what we're dealing with. But here's what it's saying. It says if we have a taxpayer who goes ahead and has a residence and they rent it out for less than 15 days during the taxable year, so a maximum of 14 days. If you hit 15 days, this rule no longer applies to you. You include it in gross income. Okay, this is going to be less than 15 days. Less than 15 days. So you rent your resident out for less than 15 days, then you can see there's no deduction. So you're not going to be able to deduct the expenses that may occur, the utilities or whatever, during the time that your guests are in the house, right? That they're over there. They're no longer going to, those costs you cannot deduct. But if we look at 2, it says the income derived shall not be included in the gross income. That's the language. That's what makes this rule work. So what this rule is saying is if we have a residence, and the residence can be our personal, or it could even be a vacation home, okay, and we rent it out for up to 15 days, so less than 15 days, let me clarify, 14 days or less, then we don't get to deduct any rental expenses associated with it, but we're not including the income. That's a pretty cool rule, right? So this is a threshold. This is a foundation that we're using when we then look at it from individuals and from businesses. Now, we're not doing something super aggressive here. This is right in the code. It's not some kind of loophole. It's things that we do, and it's a tax planning strategy, especially when you look at it from the perspective of the business. So let's go ahead and let's look at how this applies. We'll break it down by individual and by business. So here's our requirements. What we're going to do is we're going to go through on the left hand, we're going to see the category. And then what we're going to do is we're going to start out with the middle saying individual. So we're only going to look at individuals right now. After we do that, we'll jump over to business. When you're dealing with it from a business perspective, that's where more of the tax planning comes in because there's more that you can do with it. So let's look at the categories. So the first one, you rent your personal residence, right? And you're going to be, if it's for individual use, you're renting it to somebody else. You're not renting it to yourself. You're renting it to other people that are out there for a fair market value, for the rental value. The type of property, it can be either your primary or vacation home. Either one of those are going to work. You're still going to be able to go ahead and exclude the income you receive from your taxes. Now, what are some of the common uses? Well, the way I often see this is we have people that are maybe coming for graduation, so they rent out their house because there's not enough places for graduation, not enough motels or Airbnb, so they kind of rent it out as an Airbnb. Other ones, it could be because somebody's coming down to go watch the Seminoles. If they're having a great year in football, or if their soccer is winning another national title, or volleyball, or whatever it is, you have people that are coming down and they want to rent properties for it, and they might be hosting some people. And if you have a bigger house, of course, you can rent the entire house. It doesn't just have to be a room, but you can make some pretty significant money on that. Other types of things, if there's concerts out there, sometimes it's for holiday travelers, people that are coming in for the holidays, right? And it all depends on your location, where you're doing this at. Some people will even do it as just mini vacations, and what they do is they will take their own vacation during the same time they're renting out their house, and they're taking in a few $1,000s from renting their house for the 14 days to 2 weeks, and then they go on a vacation, maybe to Europe or a beach vacation or wherever it is that they want to go, and they're paying for their vacation with the income that's coming from somebody staying in their house, and their house is basically being house sat. So they're making money, they're not having to pay a house sitter, and they paid for their vacation. So you see this in all kinds of different situations. Tax treatment, like I said, it's excluded. So the individual, so when they get that proceeds, it's excluded. Now, there is a requirement here. 14 days per year is the max that you can do this. If you hit 15, you don't get any of it. It's not like you get 14 of the first hit. Nope, it's gone. So make sure that if you're going to do this, you're staying at the max of 14. The rent amount, market driven. So it depends on what the rent is. It's not a fixed amount of saying, oh, you can do $1,000 for the 14 days or whatever. It depends on your house. It depends on your location. It depends on the size of the house. It depends on so many different factors. It's just the fair market value. What can you rent it for? Okay, to a person in an arm's length transaction. You don't get to deduct any of the expenses, so that the expenses are not deductible. And then you have minimal documentation in this situation. Now, it changes when we start looking at it for business use. All right, so when we're dealing with business use, now we're not renting it to a third party. What we're doing is we're renting it to ourselves. We have our own house, and now we're renting it to our business. Okay, so our house, our personal house, is being rented to our personal business here. So here's what happens. It could be, again, your primary, or if you have a vacation home, you can use it for that as well. So it has to have a legit purpose. There has to be a legitimate purpose. What are some of the legit purposes that have been shown to be legitimate? Board meetings, strategy sessions, planning meetings, team retreats. I mean, there has to be a legitimate reason. Now, you can't just say, oh, I'm having a board session. You've got to maintain some records with this, okay? Make sure you're maintaining records, because this can make the IRS think, hey, wait a second. You're renting your own house to your business. All right, let me take a look at this, right? Maintain records, have a legitimate business purpose for why it's doing. So for example, if I wanted to go ahead and film content, maybe I need the whole house so I can film the content depending on what type of videos I'm doing, right? Well, that could be a legit business reason depending on what my business is, or if I'm doing commercials here, or if I have customers coming in. Those things can all be legit purposes. All right, maximum rental period, again, 14 days. Max is 14. So less than 15 days. That didn't change. The rent amount, now here's an issue, is fair market value. You can't just sit there and say, wow, I would love to reduce my taxable income at the business level, and what I want to do is I'm going to go ahead and I'm going to rent my house out to myself, and I'm going to pay myself $5,000 a night, and now I don't have any taxes on this, and it all works out, right? No, they're not going to let you do that. It has to be fair market value. What would you be able to do? What could you rent it to another person at an arm's length transaction for? So don't overcharge, because it's not going to work. If you get audited, you're going to run into some issues on that. So when you rent it to the business, what happens is the business has a business expense that they get to deduct. And when you get the income from the business, you don't include that in your income, right? Because it's excluded. So that's the double benefit that businesses get. This is a nice planning tool that you can use. Now, you want to make sure that your rental agreement is in writing, and you want to make sure you're documenting records. Keep minutes of the meetings that you're doing. Make sure that you have records that support it. You need evidence to support what you're doing in case you're contested. You want to be able to present it to the auditor or whoever it is, the revenue agent that's going to be reviewing this, maybe in appeals, whatever it is. You want to have those records ready for them so they can see that it is a legit business purpose, what you did, and those types of things. But make sure it is in writing. So let's go ahead now and let's talk about some of the pitfalls. I'm going to give you a few pitfalls that people use when they're trying to use this process. And again, this is called the Augusta process, the Augusta approach. What it is just saying, hey, section 280 AG. That's all that they're saying. All right. Well, let's take a look at that. Okay, so here's some of the most common mistakes that I see when dealing with Augusta transactions. Now, these are related to business, renting to your own business. Okay, these are the types of issues that I see. So the first one is overcharging the business in rent. And I understand the appeal to do it. The more that you can charge, the more you can exclude from income, the more the business can deduct, and we're all happy except the IRS. But that matters. The IRS is going to frown at that, and if you're audited, you're going to run into some issues with that. So charge a reasonable amount. Look at your location. Look at the size of your house. Look at Airbnbs or Verbos or whatever it is and see kind of what the market's going, and then use that as a baseline to be able to determine how much you can actually charge. Second one's no documentation. Hey, you need to document, because if you're audited and you cannot support this, then you're going to lose it. Okay, so make sure you're documenting, especially when you're dealing with your business. You need to document all of those expenses and what you're doing and what you were doing at the house and why you had to do this. Other things that the IRS may question is, was it a personal event just disguised as a business? Hey, it's team building during the holidays, right? I mean, yeah, okay, you need to have a reason why, again, a legit reason why, and the documentation you have should be supporting that legit reason why. This isn't just something that, hey, we can do. You have to have a legit reason. All right, and then the final one is assuming that you can do the exact same thing every single year. Hey, you know what? You need to engage in business decisions. If you're a business, you need to be looking at it. Are there things that you can do differently? Are there other types of events? I mean, you need to be looking at what your strategic decisions are, so you can show them that, hey, I've modified stuff and I've grown as a business. All right, y'all, that's the Augusta transaction. A pretty nice little planning tool that you have. So hopefully this video helped you understand that. If it did, go ahead, subscribe to my channel. And hey, look for my other videos in this tax planning series, because I go over all kinds of different series. I started out with some of the building blocks, looking at the tax code, and now we're getting into some specific types of transactions. All right, well, thank you for watching.